Good afternoon and welcome to the technical webinar of the LPA dedicated to the Big 4 private equity leaders. Today I will be hosting this panel with my colleague Michaela.
Welcome. Good afternoon.
So it's a pleasure to have you here, and we have again some usual suspects you might recognize. We have Laurent Capolaghi from EY, Vincent Lebrun from PwC, Michael Tabar from KPMG, a new guy on the block, and also Nick Tabone from Deloitte. Welcome, gentlemen. And if you remember well, we had such similar sessions last year already in April and also in May. And this is already an eternity, if you ask me. But many things have happened, many things changed, and many also have adapted to this new normal. We already discussed some of those effects in the past, and that's why today we'll focus much more on the current situation. Therefore, how do you see the global economy right now, and has your perspective on private assets changed? Gentlemen, the floor is yours.
I think the good thing is obviously the national stimulus package has brought the right level of liquidity, right? So we managed to go through that crisis by sustaining a level of growth which is good enough. The second thing I would say is that GDP is picking up in many different regions, which is a great news. So it seems that recovery, even if the recovery is not the same in all region, it seems that it is picking up. And the last thing I would say from a positive angle is that the world crisis has brought a lot of overall money, not even talking about private capital, but overall into certain sector that brought a fair amount of innovation, which I guess the vaccine, I think, is probably a good example to that. On my end, this being said, we see inflation picking up. I think that could be a strong concern. We see raw materials prices picking up, which could tackle certain sector, and as I said, not all regions are picking up the same pace, which could be an issue. And I think that would be the takeaways from my end.
Okay, well, thank you all, and well, very pleased to be with you. You know, it's my first time webinar with you guys, so very excited and sounds like fun. Yeah, I mean, definitely 2021 is so different than 2020. You know, my fellow partner David started last year, you know, playing a bit of the guitar as a highway to hell, which sounded a bit like a prediction, fortunately. So this year, well, fortunately, you will not hear me playing guitar, obviously, but that would be maybe something like Space Oddity, since seems like the planets are a bit aligned for the private assets and also for the economic growth. I mean, obviously, the first point will get control of COVID. You know, to have the economy to reopen. It looks like US is starting to get control to have this herd immunity with the 70% vaccination. Europe, I mean, we're still pretty far from that. But yeah, thanks to the fiscal stimulus, monetary stimulus, especially in the US, you know, with this 5 trillion coming from the governments, the 2.5 trillion from the Fed, which showed a 75% increase, obviously, on the balance sheet. This is driving clearly the growth. IMF is predicting a 6% growth, which has increased also its view. Obviously, my crystal ball stopped after 24 months, so yeah, positive note for the next 2 years. After, you know, humility and history show that we need to be cautious.
Yeah, maybe on my side, well, clearly we have gone through the crisis pretty well, and we have all been extremely busy. My concern is maybe whether or not, let's say, the stock market correction is coming. Let's say many are talking about it. Which is not necessarily a bad sign for the private markets players, because we see anyway a fundamental shift, let's say, from public markets to private markets, and therefore there is no doubt that alternative players, including let's say a private equity fund manager, will look at new ways let's say, sourcing even more money, and probably also including from the public. Now, when I look back through the crisis, and more specifically when it comes to private equity, it looks like the PE players have proved to be resilient and agile through the crisis. So they continue to ride this long decade of growing transaction volume, valuation, and on top of that, also, let's say, fundraising. My only hope is that while private equity is somewhere still a young industry, but I hope that they are not young enough to just remember what happened in 2008, because, well, when you look at the deal leverage, they are at new highs. Valuation and multiples are at the highest. So I just hope that they will take the lessons from the past. But all in one, well, private equity does extremely well for the time being, and probably they do better than, let's say, non-backed, let's say, private equity companies, because of course PE-backed entities, they have access to financing and so on to go through the crisis. So if there is a correction post-crisis, which nobody can exclude, probably the PE industry will continue to perform.
Right. Without repeating what was said, so hi everyone. I think the resilience is something key, and I think what was also surprising is the amount of innovation that has come out over the last 15 months, and that innovation is also backed by a lot of the PE asset managers that we serve, and I think that is something that is a very positive sign, and it's something that we should all be looking forward to in that respect. And obviously, I second Vincent when he says about the high leverage points that we have today can be a source of concern. Hopefully not, if things stay as they are. But again, the amount of movement and change that has happened over the last 15 months is something that we haven't seen before, and I think there's definitely more to come in that respect. But resilience is there, which is I think very positive.
It's even hard not to get excited, you know, all the industry rebounded over the last 12 months. I mean, since we talk about the big four, you know, I look at the big four private equity players, you know, the Blackstone, Apollo, Carlyle, and KKR. I mean, when you look at the number of these guys, it's fantastic for what they have done for the last quarter in 2021. You know, Blackstone showed a profit of 1.8 billion profits compared to the 1 billion loss of the same quarter last year. I mean, in all the dimension of distributor earnings, AUM, portfolio appreciation, I mean, these guys shown different numbers than 2020. So definitely, it's a great time to be working with private equity for the months to come.
And what you said, Michael, I think it's interesting to see how resilient those PE houses have been, right? So they went multi-strategies, which is a trend which we see a lot. So just not only just on the PE side of it, but going as far and stretch as far as traditional asset management, which I think is very interesting. So they really try in all ways possible to expand their asset under management, and therefore the management fee they get out of it. I think another trend which is interesting when it comes to private capital in a post-COVID scenario is this saturation in some geographies, which we could have noticed. I think we discussed last time during the second edition. We definitely see some geographies where the amount of liquidity available is incredibly high, which obviously also fuel the level of valuation which we all mentioned earlier on, and it's probably a concern for the industry, or at least it's fair to say that we are reaching new high in that regard. And maybe a last thing, and maybe which is more philosophical, but I'm sure it's quite interesting to mention, that came in my mind when we just discussed this, is this this overall uncorrelation between public market and private market. You know, we think we mentioned that many times private equity is so strong because public and private market are not correlated. it seems now with the amount of liquidity that is brought in, that there is, to a certain extent, some correlation between those two markets, which obviously does not help if at any time something slow down on the public market scene, right?
As you mentioned, like any industry, private equity is going through major challenges. How has the sector evolved and how does the future look like?
It's a great question. You know, it's good that we have 2 hours ahead of us to go through the different dimensions, right? I can start just by a few factors that I've seen. I mean, obviously, the first one, which is good for us working in the industry, is the increased allocation of the asset under management to private equity. We did some survey in the Asia Pacific, and 79% of the LPs we survey say, I mean, there is no doubt we're going to increase allocation to private equity. It's good also that we have the regulator helping us on debts and giving access to one of the best asset class. The SEC with the letter in 2020 that's basically said that for the 400 401k plan, I mean, that's fine not to have private equity for employees. The mega funds as well is a trend. Back in 2006, there was only one mega fund that was like around 8 billions. Now when we talk about mega funds, it's like 20 billions, and 6 mega funds has actually been raised during the last 3 years. So even though there is indeed, Laurent mentioned, some more thematic splitting strategies, still mega funds will be there.
No, I agree with you, because, well, one may say that investors are hunting for returns. That's why I said we see a clear shift from public markets to the private ones. This probably also explains the conversions that we see where, let's say, the very large fund manager, PE players are going right now, let's say, multi-investment strategies, because they see the opportunity to fundraise. And therefore they are coming up with new investment strategies and so on to raise money as much as they can. And what I also noticed is that, well, when you look at the statistics, while PE is still outperforming since 20 years the public markets, but based on some analysis that we have seen is that, let's say, in the mind of investors, which were exposed to public and to private markets, they feel actually much more comfortable in investing into private markets right now, because private markets seems to be much safer from an investment perspective than public markets. And let's say the players, the PE players, I mean the fund managers or companies backed by a private equity fund, as I said, have been proved to better recover out of a global financial crisis, and I think that's why we see this shift of investors going much more to private than public compared to the past, which explains, of course, this huge success that the fund managers, the alternative fund managers, are facing right now, because it becomes much easier for them to raise money compared to the past. They raise money in a much quicker time, but also they are raising much more important amounts compared to the past also.
And I think there's also a new source of capital, because there's many more high net worth individuals that are attracted to this foray, which has also helped in terms of increasing liquidity. And the other thing as well is discovering that they can do deals virtually was something unprecedented. So I think the way they managed to do that and to align, I mean, life needed to go on, so they had to do deals because of the dry capital that they had, and the fact that they managed to not only do the investment but also raise capital. Michael, as you said, a significant amount of funds were raised, notwithstanding the crisis and the liquidity issue. So that's something I think that the way the asset managers have adapted to this COVID situation, and I think it will not, I doubt it very much that it will go back to the days when everyone just used to take a plane to go and make a deal, because I think everyone has seen that you don't need to do it, or at least you don't need to do it as often in that respect. And I'm pretty sure that the way things are going, still you can do things on a virtual basis. So that digitalization of the PE asset managers, I mean, started, needs to continue, because again, there are still things that they do which are increasingly manual. But I think they have adapted as well from a digitalization perspective, and I think there's more to come in that respect, because what we see is a lot of investments being done in digitalizing the way they do their service. So I think that's the evolution which would probably not have happened had we not had such a pandemic.
I fully agree, Nick. And on one end, on the other end, there is still a very, very long way to go, right? So this is still very bespoke, and both when you look at digitalization, it's still very bespoke, both at the level of the fund, at the level of the target company, maybe the target company will pick up first, and also in the way the target companies are reporting to the funds, and the way you can use data and data analytic overall. I think the trend and the challenge around the retailization of the private equity is an interesting one. I think probably was to mention here to the audience, just to pick one. I think we would all agree this is not a challenge, right? So this is just an evolution, but it's fair to say that the mass affluent clientele and investors and the high net worth individual are currently now super keen to invest in private equity. And maybe we want to talk about the SPAC later on, but even the SPAC aside, just looking at those platforms that now allows those private investors to step in and invest into private equity funds, provided they're professional investors, of course, and in line with the regulation, is a very, very interesting evolution of the market, which we could hardly perceive a few years ago. And as you said, considering the interest and the appetite of that segment, which, if you add them up, can represent a fair amount of money, is quite interesting for the industry.
Yeah, I mean, obviously we're gonna have to talk about SPACs, right? But in Europe and Luxembourg in particular, I mean, when we talk about retail and private equity, I'm a strong believer of the LTIF product, even though, I mean, it didn't happen really in the past for some reason. And one is the difficulty, obviously, and there was not so much appetite to go for this. But no, I mean, we're expecting a new revision of the LTIF regime that hopefully will simplify it for the retails to enter the product. Obviously, a nice tax regime that Italy has put in place will help there. I mean, and it's a fancy vehicle also to fuel the real economy, in infrastructure, private equity, and I mean, we need it based on the deficit in finance there. So of course, I mean, nothing would prevent retail, again, to have access to the best of class in terms of resilience. But I mean, Luxembourg, obviously, the growth will come from the private bankers. And we start to see also quite interesting joint venture between private bankers and GPs to package some of the private equity, obviously with a lower ticket that we've seen in the past. But that is an interesting, trend that we observe here.
We echo what you said, Michael, on the LTIF2. I think the reform is quite promising, provided we manage to wrap it up with proper tax regime, as you rightly highlight. I think it's quite promising because the current version and what can come out of the second version is really take us the next mile in terms of eligibility of assets, evergreen structure, the way the world governance around the LTIF. I think it could be indeed it could be a very promising vehicle, despite the fact that the first one has been unfortunately did not pick up at all. The second one could be completely different.
I'm not sure I agree with you both on that one. I have my doubts on whether that product would work. I hope it does, but I do have my doubts as well that asset managers might not think about other solutions to attract more capital in that respect. I think the notion of permanent capital is slowly as well coming in and becoming more interesting. The LTIF tool, yes, is something that will help along those lines. Given the bad publicity it got in the round one of when it was launched, it doesn't convince me. I hope to be proved wrong, but it doesn't convince me that because of the name it has, will be taken up by asset managers.
Yeah, I was in the same view than you, Nick, a couple of months ago, but since then, when you see the level of savings in banks, and we know with negative interest, even, I mean, we talk about 250K, in banks, so obviously everyone is looking to invest in a stable asset class, and that's what makes change my mind on that.
I think, Nick, what you're saying is quite interesting. I think it will all depend on the way it gets distributed, right? So the package, what is in the regulatory package seems attractive, but I agree with you. Of course, if the way it gets distributed does not follow, and obviously if we stick to the traditional, wrapper that we currently have, of course that won't be a success. But what I was saying is, at least the regulator and further to the consultation, things have changed in right directions, right? The first one was was very difficult to come up with something that is attractive, and hopefully this one is more suitable to the purpose, I would say.
To also echo what you, I mean, your question, transformation of the private equity, well, I believe there will be a big focus on value creation, since I mean we see the multiples quite high, so that's obviously it's difficult to get a good deal. It will get difficult to get a good deal. So they will have to work a lot on value creation, and all the teams will have to to focus on that one.
I totally agree on that point, and I forgot, but there has been a study made by, I think it was an American university, where they have been able to identify, let's say, within the performance of PE houses, that the ones who had what we call a valuation creation team, that they have actually not only a better performance, but that those PE houses equipped with such a team have been able to go through the crisis with, let's say, the 2008 one, because we still don't know what could be the impact of the current one. But when they look at what happened back in 2008, that those ones have gone through the crisis with a much lower impact on their valuation. So valuation creation is clearly key for them if they want to stay attractive in the future. And I think it will also play a key role in their success for future fundraising, I think.
And I think you see that as well with the recruitment that some asset managers are making, because they're recruiting industry specialists and not only makers. And I think that is going in the same direction as you've been mentioning for the value creation. It's quite typical, and the reasons are obvious: the high multiples and needing to do something about that by creating value rather than winning on the leverage side.
Yeah.
And frankly speaking, it's the beauty of private equity. I mean, with all due respect, with other asset class, I mean, that's really where private equity, stands out. It's on the value creation, working on the company fundamentals, and well, that's what also we see this resilience, is because the portfolio company have been, supported financially, but also from a management point of view. So that's what made a difference to infra or real estate, in my view.
You just mentioned value creation and also before valuations. Concerning that specific element, are we back to normal? And how was that handled in this new world full of uncertainties? Anything on that?
So to me, if I take it, I'm not sure that to me, but I think if I take it, what we see is really emergence of those two buckets, right? So on one end, we have the geographies, the ones where the national stimulus have been high enough that kind of sustain the growth, and as it has been said earlier, Asia and US that are certainly ahead. We see this is another buckets for sectors. Sector-wise, of course, as we said last time, there's a couple of sectors that really took advantage of the crisis, or naturally took advantage of the crisis, or the online businesses, which obviously play a role, which you naturally see as part of the valuation exercise. This being said, some geographies are not yet out of it. So as far as I see it, we're still working on normalize EBITDA in a post-crisis scenario. So that would be, my take from a pure technical perspective. When you look at the valuation levels, so we mentioned that earlier on, they are incredibly high. We are obviously, and that's what I meant earlier on with this correlation between public and private. Public markets are really solid in terms of their performance, which has an impact on the overall valuation metrics. So now it needs to be seen how does that translate in this new era that we mentioned earlier in terms of inflation stepping in, difficulties to access raw materials in certain sectors, the consequences it may have on certain company that, despite the fact that they're able to recover, cannot have access to what they need to actually create value to their clientele.
And I think there's also another thing that we need to look at. It's the sector and the type of investment being made, or the products used, so the equity / the debt investments. Because I think there, when looking at cash flows, I mean, we've seen impacts in terms of not reducing cash flow but delaying the cash flows, and obviously those have impacts on certain of the valuations. But I don't think it's as negative or pessimistic that we were in the previous discussions that I think we had, especially the first one, which was just when the pandemic hit, when the Q2 valuations really took a hit across the board. And I think they quickly recovered in Q3 and Q4 in the street. But obviously, certain of the cash flows and the underlying principles and assumptions did have an effect, and they were a bit harder. If I put my auditor's hat on, a bit harder to audit this year in that respect, because it's not a normal year for the cash flows or even the projections for 2021, because again we're still not fully out of the pandemic. So a few more discussions were held, I can say, in terms of valuation, so than in previous years. But I think overall they're trending in the right direction. And I mean, healthcare and tech companies were probably the ones that had the best probably valuations that we've seen, because of the nature and what was happening in the pandemic.
Yeah, you mentioned, Laurent, that the valuation is quite high. I would fully agree on that, especially for the US market. And what is remarkable in this year is the divergence between Europe and US. I mean, when you look at the multiples, we see an average. I mean, Europe is between 10 and 14. US is like between 15 and 20. So there is big divergence that we've noted. There are a couple of factors, in my view, that will explain that. I mean, you mentioned the public markets. I mean, in Europe, the performance was very poor compared to the US. Again, going back to the discussion we had on the stimulus, the fiscal and the monetary stimulus in the US, that has nothing to compare to Europe. Obviously, also in US, you will have much more like proof pandemic assets. IT, healthcare assets are much more prominent in the US than in Europe. So you have a premium to that. And well, for the trend, obviously, there will be a big hunt for deals. The level of dry powder has increased by 20%. There was no much deal in 2020, but with SPACs coming in, obviously there will be a lot of competition. There will obviously will drive again the multiples up. So there will be good bargains in Europe. Still, US, you know, I don't want to comment on that one.
Maybe on the valuation multiple, something which we've seen and is probably worth mentioning is the diversity within Europe. So obviously, certainly in Central Eastern Europe being certainly an Eldorado for private equity, where you see many players trying to tapping this new market, where the number of players are not that significant, and that link it up with what we said earlier around geographies. There's been a rush around DAC region and those mature market, especially on the private debt side of it. And obviously Central Eastern Europe and some of the med market seems to be a market where some houses are expanding, and certainly Central Eastern Europe as far as Europe's concerned.
Yeah, but I would add that we need to be nevertheless quite prudent about valuations, because they are rated, well, in average, quite high. There is a lot of dry powder, as mentioned. The dry powder needs to be invested, so they are ready to pay higher prices. But when we look more at the exit side, unfortunately, what we see is a lot of secondary transactions from one fund to another fund. And we see a large number of fund managers going for what I would call a continuation fund. So they need to close their existing fund, but they still are sitting on a large number of assets where they believe, okay, maybe the assets could better perform in the near future, or they are struggling to find a buyer for it. And so they push these assets not only into a continuation fund with the existing, let's say, investor from that specific fund, but sometimes we also see more and more, let's say, a generation of a fund, let's say fund one of a specific player, transferring these assets into generation two funds. And so we should be careful about, let's say, valuation when I see and when I look at what is, let's say, really happening on the market, let's say, right now with those transactions between fund to fund and from one fund generation to the next one, and continuation funds where, let's say, LPs are asked to hold, let's say, their investments into the fund for a longer period than expected. So this is also a sign that valuation could be somewhat a danger for the future.
It is a danger, yeah, certainly.
Yeah.
There was something that we, you know, that we noted during the 2020 audits. That was this undue conservatism at some point, meaning to be too cautious, which I think is a normal human bias, to be too cautious, or especially as, say, auditor or being in Luxembourg, you know, with this low-com approach, prudent approach, which is more continental. Well, we are fair value, right? So, okay, I understand it's more, you're confident more to be cautious, but we need still to be fair value. So sometimes we're interesting discussion with clients saying, you know, let's wait. No, we are in the middle of the crisis. Well, you still need to, I mean, to represent what is the right price.
We recently heard a lot about SPACs, ESG, and digital transformation. Are these buzzwords or long-term trends for our industry? Nick, would you like to start?
The digital transformation, I think, is there. It started, and it's still quite a long way to go, I think, because of the young age of the industry, basically, and the lack of digitalization in a lot of the key areas, which is obviously taken a robust ramp up in the last 12 months, which was undue. ESG is definitely a topic that is out there. I mean, it's more pressure coming from the LPs that is driving this, because a lot of LPs are very ESG conscious, or at least want to look like in that respect. The difficult part there that I see going forward is measuring these types of funds, measuring their ESG impact, because everyone will start to claim within their prospectus that yes, this is an ESG fund, but it's going to be very difficult in my mind to have reliable KPIs that are consistent across the board. Because I think there are quite a few out there, but are they consistent one with another? I think that is something as well that we are going to be face. I think Luxembourg is quite well placed in that domain. Should new funds or such funds be created, so I think that's something positive that we need to take into and SPACs. Yes, SPACs. I would put them into two buckets. Your typical SPAC, which is a promoter listing an empty company and then starting to look for a portfolio company. Then you have, on the other hand, you have portfolio companies that wish to go to the SPAC route because it's quicker. It's more costlier for them, yes, but it's quicker. And I think those are the two areas. I'm personally not very comfortable with the first one when there's a lot of uncertainty in that. I mean, you hear a lot of rumors of a lot of money being raised and not being spent and being taken away. So there's that aspect as well that needs to be considered. Whereas for me, on the second bucket, I would pin it more or assimilate it more to a normal listing, but on a faster route in that respect.
To complement on the SPACs, Nick, I think that really the good thing, as you said, is the amount of liquidity that can bring, right? As you said, so even for a target for an operating company, for a fund, that could be a fantastic opportunity to get both, and bringing the liquidity, I think, is always a great thing, right? So on one end, on the other end. And Luxembourg is playing that key role at the moment. We see those SPACs picking up. On the other end, as you said, there is a kind of a disalignment of interest, right? So not like what we have for PE funds, where the manager that select the investment get incentive on the amount of money is on the value basically that is creating out of the target company he acquires. For a promoter of a SPAC, obviously the cash in is immediate, so it's a question of finding the target, and then there is no long-term incentive. There are some, but this is not at the heart of the product, which obviously this lack of alignment of interest makes it so different to our world, to the world of private equity, I would say, to complement on the SPAC question.
Well, yeah, I agree with everything. Clearly, the SPAC will create some liquidity and probably also some exit routes for some players. But I also believe that the SPAC system might be used for fundraising purposes on top of, so we mentioned the LTIF. I would not also exclude what I call, let's say, blockchain tokenization being also a kind of a fundraising system for the future. Now, just a few words on ESG. Clearly, it's a big trend, and this trend will increase. I'm just a little bit worried that this trend is somewhat used in a way or the other by the fund manager to do some fundraising. And there is, as mentioned, I don't remember by some of you, that let's say the pressure comes from the LPs, but what we see at the same time is that let's say fund manager looking to raise an ESG or a sustainable fund, they get a different kind of pressure now from the LPs, where let's say the carry that they might take out of such a fund is subject to clear ESG or sustainability KPIs. And that's something which is, let's say, totally new in the industry, because they will come up with financial and let's say unusual type of ESG sustainable KPIs, which could really impact, let's say, the fund manager if they don't really go to the end of this trend, which is ESG actually. So some of them are using ESG as a marketing purposes. But I think long-term, let's say, they return, which could be either the management fee or let's say the carry, could actually be negatively impacted if they don't perform as expected by the investors or by the market.
Yeah, I think what interesting SPACs and ESG have in common is both of them actually started from the business, from the investors. And now they've been caught up by the regulator at the same time. And well, SPACs, I don't know if you've seen the latest statistics, there was an average of 80 SPACs per month for the last, from the last 2 years. And in April, there have been only 10 or 14. So it looks like the market is collapsing. And my view on this is because of the regulator. The SEC has clarified that for them, the warrant, and I don't want to be technical on that, but the warrant used for the de-SPAC has to be classified as liability, not equity. So it forced the sponsor to fair value on a quarterly basis this liability, which obviously is quite complex since the warrants are not plain vanilla. And the second aspect is the SEC also say, well, actually the de-SPAC process is the IPO. So this, in their view, will trigger actually to have all the requirement of an IPO, like the prospectus, projection also, because we've seen also crazy projections on target companies to be subject to comfort letter, this kind of thing. So, probably the decrease of the SPACs market is related to that. Now in Europe, we need this kind of vehicles. We need to support, companies in Europe. We need to support them. We've seen beautiful companies getting outside Europe, acquired by US companies. So that's definitely a good thing for Europe. And here, what is good is the CSF is obviously the good players with the time to market, which is key for SPAC. So, we are winning somehow the battle. Amsterdam is still there, but it looks like the CF is clearly on track for this. And last thing on ESG, again, regulator with the FSB, and Europe with EU taxonomy are making things complex, redundant. BlackRock CEO wrote a letter in Jan saying to the companies, you need to disclose how you will be meeting this net zero target. What I don't like with ESG, though, it's used now as a marketing tool for performance. So they've been using ESG to justify the good performance. And I'm sorry for that, but you don't justify good actions with performance. So I think ESG, you need to show that you are a good citizen, but it's not a tool to make performance. Again, it's my personal view on that.
And maybe to complement on what you say, Michael, on ESG, and to your point, Michaela, on whether this is a buzzword or not, I think what we're hearing and what everybody's seeing is it is not a buzzword. This is certainly something which is very serious. Recently, there's been more light being shed on ESG because of SFDR and the overall regulatory reform and the EU Sustainable Finance Action Plan implementation. But if you look at it, a lot of PE managers have included already for quite a long time sustainability risk when assessing the acquisition of an investment. So this is certainly something that will not stop and will continue actually with as you said, Nick, with more now the next challenge being the actual measurement, the harmonization of the KPIs, right? Because this is all about extra financial return, so which entail different KPI based on sectors and the way you can compare. I think a lot of us are coming from an accounting background. Extra financial return is exactly about that, right? So we just need to find the generally accepted principle to get this compared across the board to measure what is this extra financial return being performed and being generated by the manager.
If we now zoom back to Luxembourg, the EU competition is not sleeping. They are evolving too. Any opportunities we should develop here in Luxembourg in order to stay and remain really the best private equity place in Europe? And secondly, what are key actions Luxembourg stakeholders and practitioners should focus on this specific year? Large questions.
Well, it is without doubt that Luxembourg has faced a tremendous success when it comes to alternative industry in general, and it was actually quite difficult for any other jurisdictions to beat us, because we were let's say, the preferred choice of fund managers, whether it's for fundraising or, let's say, acquisition or financing, let's say, structure. However, as the alternative industry leader at PwC, while we are performing extremely well right now, I must say I'm a little bit concerned for the future. And this is because I'm seeing numbers, let's say statistics, which I don't really like. Just to share a couple of them, when you look at Ireland, let's say Ireland is growing in alternative assets under management by a much bigger amount than Luxembourg right now. The last figure I've seen is that Ireland is growing by 14% IOM, where Luxembourg is growing by 7%. When you look at the impact of Brexit, a majority of the, let's say, fund managers have relocated to Ireland. So Ireland, to me, is the winner of Brexit. Of course, Luxembourg comes as second and Paris as third. And when I see also at, let's say, the point that Luxembourg has been so well performing in the past, so successful, that this has created jealousy within Europe. With not only an impact on let's say, on the regulatory side or on the tax side, but I see, let's say, other jurisdictions, and not only Ireland, but let's say Netherlands, and probably also the UK post-Brexit, trying to reinvent themselves to become much more attractive. And so that means that whereas in the past, and I mean in the recent past, when it was about fundraising, there was no question about Luxembourg. Luxembourg was the only destination. But right now I see that there is a beauty contest for some fund managers, and the beauty contest is between Luxembourg and Ireland right now. And let's say Ireland is quite attractive because they have not only copied Luxembourg with their new partnership system, but they have also been much more clever in implementing the recent, let's say, tax measure coming out from ATAD 1 and ATAD 2. And so they have today an advantage. And my main concern is, and again, I'm not here as with my hat as a P leader, but as an alternative industry leader, is that because of the, let's say, the bad management, let's call it the bad management, the too quick implementation of the ATAD 1 rules in Luxembourg, where Ireland has implemented those rules in a much more friendly way, one may say that we are losing today on the hedge fund side and on the debt fund, let's say, structures towards Ireland. And my concern is, well, as we said at the beginning, we see a convergence where the large fund managers are going multi-strategy, but there is something we should never forget, is that a fund manager which has a multi-strategy will always want to operate out of a single jurisdiction. And so this is to say that if we start to lose on the hedge fund side and the debt side, my question is, how long will it take for a fund manager to also raise its next fund, real estate or private equity, out of Ireland instead of Luxembourg? So my message here is to say, well, incredible success in Luxembourg, an amazing one, but clearly we should stop resting on our laurels, and it's time for us to reinvent ourselves. I mean, in Luxembourg, to stay really competitive, because Luxembourg has one disadvantage compared to Ireland, is that we should not underestimate that Ireland is closer to the UK and closer to the US, only from a language perspective, let's say, but also from a, let's say, a mindset point of view. They are extremely aggressive in marketing, and we know that Luxembourg is good at marketing, but nothing comparable to what Ireland is able to do. So we should really be careful, and it's time to do a real due diligence on our tools. Let's say the different products available, but also look at what we can do and improve on the tax side, but also on the regulatory side, in order to stay competitive compared to other jurisdictions. And it's when it comes to tax, let's not forget, Luxembourg corporate tax rate is 25%, Ireland is 12.5%. If tomorrow tax structuring becomes much more difficult, well, the choice will be easy. You will go for 12.5% because no need to do any tax structuring. Or if tax structuring becomes, let's say, much more difficult than it is right now. So this is clearly a concern for me, and it's really high on the radar. And we should really think, let's say, not only between service providers, fund managers, players based in Luxembourg, and the different associations available in Luxembourg, to really think and have a big push on whatever we can do at the government level to explain that, well, the reality is a little bit changing, and the future looks a little bit less gloomy to me than it was a couple of years ago, or even I would say 1 or 2 years ago. So it's maybe a pessimistic analysis from my point of view, but while being in the business for more 24 years, I can see the change, I can see the shift, and it's really firsthand that I see a negative trend, and where Luxembourg is not always the winner out of a beauty contest between those two jurisdictions. And let's not forget, okay, Ireland is playing a big role right now, but I'm convinced that London will come up with something.
Thanks.
I don't know you guys, but I'm completely depressed now. We started with a positive note, and now I'm completely depressed.
Well, you know,
no, but there are good points, so I understand there are good points, but I think that, I mean, some sunshine as well.
I think we should not be depressed, right? So we've been through that in the past. We have faced those challenges, and I think this is realistic to raise this, because this is what it is. So there is proper competition amongst member states, and what we need here more than ever, we need to speak as one voice and defend the financial center as we've always done in the past, and we've been super successful in doing that. So more than ever, this is what we need. Another element, and I agree with what you said, the way some member states have acted. One of the way to tackle it, and happy to get the view of the audience of this, is obviously on the talent side of it, right? So we have grown so much, and Luxembourg has been, you know, very, very good in attracting, basically in shifting from pre to post AIFM, and we see this inbound substance and inbound asset under management. The talent side of it, to me, is very crucial in the next 12 months, right? So we need the right people, skilled enough, educated enough, and for that, I think we also need the help of the financial sector overall, making sure that those talented people can join us to continue to also fuel the growth, which I think is also another element to what you said, Vincent. Again, it's not a question of being pessimistic at all, but this is something which should be high enough on the agenda. This is just being realistic, and this is the to your question, Stefan. Those are challenges, no doubt. We can overcome those challenges, but we need to act now, and this is what is at stake, really. And also maybe to clarify what Vincent mentioned. Edge have been indeed. I mean, there's lots of assets that have shifted, and the same with private debt. The core PE side of it, I think it's fair to say that Luxembourg is still well positioned, and which obviously, so PE, infra, VC, and the sub strategies, which is a bit brighter than what someone would.
Yeah, but Michael, just to clarify, so no need to be pessimistic. So I just said I'm a little bit concerned, but it's the first time that we see numbers which are self-speaking. And let's say if now Ireland is growing by the same numbers that Luxembourg was growing a couple of years ago, and where now the growth in Luxembourg is lower than Ireland, I think it's really time to be realistic and to question ourselves, okay, what should we do to stay as much as possible competitive? Of course, Luxembourg cannot be the single location or single jurisdiction to welcome those players in the future. The cake is becoming bigger and bigger. So when you look at the stats, alternatives should represent 15 trillion by 2025. Of course, Luxembourg cannot, let's say, catch everything out of it, but one of our duties is to make sure that we stay competitive. And for the time being, I don't really see any signs coming from the government which goes into the direction or where they give the sign to understand that we have no other competitors compared to 2 years ago. So that's
but competition is good. I mean, it keeps you sharp and no frustration. Some points leads to creativity, which what we need for the future. So, I mean, I hear what you say. I'm an auditor, so I'm cautious by nature, but still, I am quite confident for a couple of reasons. I'm going to be brief to let Nico complement. I mean, we are the key jurisdiction for private equity and in-house IFM. I mean, there is no doubt into that. And we are in a business where the winner takes it over. So if we have the IFM here in Luxembourg, and in private assets, PE is more than 50%. So there is no way that they're going to start diversify the activities and going between Ireland and Luxembourg. So I see my clients saying, well, what you guys have in Luxembourg in terms of products, tax, still it's good. I mean, we'll go for Luxembourg. It's less complex in terms of structuring. That's the Irish LPs. So they still love our limited partnership and corporate limited partnership. We see also, good candidate for global compliance. So we have key people also moving to Luxembourg. It's a strong signal. I've just heard 2 new fund admin coming from US to do fund admin here in Luxembourg. I think these guys don't move, for nothing. They've made an analysis and they believe also Luxembourg is the good part. Where I agree fully with you, it's we should be careful not to be itchy to some of them. There was a couple of things. I don't want to mention this, it has been solved, but we indeed having talents, being together, service providers, serving the clients is key for this industry. And I know this kind of webinar is show that we can be competitor, but when it's about Luxembourg and private equity, we are together and want to obviously sell Luxembourg and see the good thing about Luxembourg. And there are good things to come. So sorry for being long, but I'm passionate about Luxembourg, the future of private equity, so it's difficult to stop.
I think I agree with all of you, because I think we all have the positives, the negatives. There's obviously circumstances which lead to be a bit less optimistic. I would not say pessimistic, but a bit less optimistic than we have been in the past few years, because I think competition has caught up. I mean, let's face it, we have to be honest. I think that is it. In Vincent, the growth rates are higher. They started from a lower part as well. So I think they're catching up, which is, it makes sense. And I think what Luxembourg did to the other the other jurisdictions is overtook by a lot over the last few years. So I think historically Luxembourg has shown that it is resilient when faced with serious challenges. I mean, we've seen that in the last few years as well. When things don't go the way they should, they are quickly resolved, because it's easy to approach the key stakeholders. And I think that is a strength which other jurisdictions don't really have. And you mentioned Dublin and London. I don't think they have that close proximity with the authorities, the regulators that allow for change to happen in a quick manner, in a resilient manner. And I think the one thing I definitely agree with you is we should never rest on our laurels, because there is still a lot of work to do. And as we saw that the asset managers are changing, the environment is changing, Luxembourg cannot stay as it is. It needs to, again, continue to reinvent itself to remain attractive. I'm a firm believer that we will remain the location of choice, as long as we continue to move at the same pace as the others are moving in terms of innovation and innovative things. I think the openness that Luxembourg had, and I say had because there are certain areas where we can be more open as we have been in the past, and I think this is something that investors and asset managers are are lacking and missing, because they were used to something very positive, which was not going against any law, any competition or whatever, but it's something that has been tightened up, and I think needs to come back, because that is definitely was the main advantage of Luxembourg in terms of being open. And I think that's where we need to be, and probably as part of the reinvention that Luxembourg needs to undergo from a financial marketplace, it is definitely part of that. And then again, I'm a strong believer that it can be done, because we've seen it being done already. So there is good process there. Yes, I agree. Less optimistic than have been in the past few years, but I stay optimistic.
And also from the LPA perspective, we are certainly always very optimistic, but also realistic. That's why we have really increased our thought leadership and public advocacy activities. That's why we heavily count on you also to join us as ambassadors who are discussing those topics with the HCPF, with the CSSF working groups, with the other public stakeholders, sister associations, and also then finally the technical committees and clubs who also work on a day-to-day basis on such very important topics, including also new regulatory changes, etc. So we are here to do that, and we really count on you guys. But thank you for this frank exchange.
Of course, you can count on us. Yeah.
Speakers, thank you very much to all of you, our attendees. It was a pleasure for me to be today with you. Let me introduce our next webinars. We have next Tuesday, Career Adventure with PwC. Also, we have on Wednesday, the Luxembourg PEVC Stories with Stephanie from Sofina, and AML webinar with CSSF on 27th of May. Thank you very much for being with us. Thank you to all of our panelists, also attendees, and see you soon, hopefully next week.
Bye-bye.
Goodbye. Bye.
Thank you very much. Bye-bye.